Are you tired of property management headaches and dealing with residential tenants, but feel that you're trapped because you have a huge taxable gain if you just sold the property and cashed out and paid the taxes? You might want to consider net lease properties. We'll unravel that today on Go Ahead Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to the Go Ahead Ask podcast by the Exeter Group, where we unravel the mystery of investment real estate. Our objective is to provide investors with better quality information so they can make better informed investment decisions. I'm your host today, Bill Exeter, CEO and president of the Exeter 1031 Exchange Services. And part of our family of companies includes Exeter 1031 Exchange Services that acts as a qualified intermediary for all types of 1031 exchanges in all 50 states. It also includes Exeter Trust Company that serves as custodian for self-directed IRAs, as trustee for title holding trusts or land trusts, as escrow agent for specialty holding escrows, and as custodian just for general custody services. As always, we encourage your questions or your topics, so please email us at ask@exeterco.com or call us at area code 619-239-3091. And if you love Go Ahead Ask, please like it, subscribe to it, and share it with your friends and family. Today, the podcast is entitled Unraveling the Mystery of Net Lease Properties. You know, we've received over the years many questions from our listeners as well as our clients about the frustrations of dealing with all sorts of property management headaches and residential tenants and all sorts of what they call the terrible T's, you know, the tenants trash toilets, toddlers, teenagers, etc., with those properties. And most of these obviously center around the frustrations of owning that type of real property. And so they're looking for solutions. And they often sit down with their accountant and find out if they just sell the property and cash out and pay the tax, they have a huge surprise waiting for them. So one of those potential solutions is to do a 1031 exchange into net lease properties. And we're going to unravel that mystery today. So I'm really excited today to have both a friend and colleague as an expert on net lease properties, Joel Owens, who's president of Triple Net Invest. And Joel not only has the expertise, but he has the experience to guide investors through the net lease properties. So Joel, welcome to the show.
Thanks, glad to be here.
So let's go ahead and unravel this mystery. You know, a lot of people call this triple net lease or NNN or all sorts of subcategories, sub-names. So first of all, what is a net lease property?
So an absolute triple net property, a triple net lease, people think of absolute NNN, which means the tenant is doing everything with the property. They're doing the property taxes, they're doing the insurance, they're maintaining the building. The real estate investor really doesn't do anything. It's almost like owning a stock, but you own real estate and you have the tax depreciation benefits with the property.
And is there different types of net lease properties where the tenant doesn't have all of the responsibilities, but some of that gets passed on to the landlord, or they share both of those costs?
Yeah, so there's, instead of an absolute triple net, and this happens often, a lot of times the brokers will create an offering memorandum or a flyer for the property. And it's usually done by virtual assistants or junior agents. And there's oftentimes errors in there. And so it'll say absolute triple net. But when you actually read into it, it's a double net lease. And a double net lease, you know, typically for my clients, I don't want to see anything more than roof and structure, because the structure, you can have a building inspection and you can ask the seller for repairs or credits to take care of any issues that are found in advance before you close on the property. And if it's a roof, typically there's a roof warranty that transfers to the new owner of the property. So anything below that, it starts getting into utility lines that run underneath the parking lot, and it almost turns into a gross lease in certain situations where that takes away from the whole principle of a triple net property to begin with.
Gotcha. That reminds me of shouldn't bring this up, but it reminds me of a comedian that I watched. This goes back years ago, and he had a real estate background, which is the funny part. And he said, "What is this with this net lease? I thought net was net, but you've got net, double net, triple net, absolute net. I thought net was just net." And I thought, that's a good point. It is funny how you get these industry terms and they mean something totally different. And then, do you get involved also with like ground leases and leasehold interests and those type of investments as well, or is it mostly just focused on the net lease type product?
Yeah, so there's a bunch of different subsectors of triple net leases, and I do them all. I mean, I review about 1,000 properties a week across the country. I'm a specialist in this field. The other types of leases, you don't come across them as often. They're more of a smaller part of the triple net space. And so with a ground lease, typically what happens is one of the benefits to a ground lease is you don't own the building, you own the land. So the rent per square foot in the lease is typically under market for that area. So you can have a strong suburban to urban core area, and maybe an absolute triple net lease where the land in the building is $35 a foot and the ground lease is $18 a foot. So in that example, you might be able to afford a high quality national tenant that would go for absolute triple net for 5 or 6 million, but on the ground lease it's 3 million. So you could actually afford it that way, whereas the other way, maybe it's out of your price range. One of the downsides to the ground lease is you don't own the building, so you don't have any tax depreciation with it. But typically at the end of the primary lease term, if the tenant doesn't renew the option, you usually get the building for free. So if they didn't renew the option period, you can convert the ground lease to an absolute triple net lease at higher market rents with the next tenant that you put in place on the property.
Joel, you made a comment about ground leases where they own the lease or the ground, the dirt, and not the building, et cetera. And then at the end of the lease term, if the tenant fails to renew, the building reverts to the owner of the dirt, and they get a building. And so I was just kind of curious, does that happen very often? Do you see that a lot?
Some tenants are, their life cycle, the business, a Walgreens, for instance, could be in business for 80 or 100 years versus a quick service restaurant concept could be in business for 20 years, and then be bought out by another company or rebranded and things like that. So there's various reasons why a tenant wouldn't renew a lease. If their business model is going to more online, or they wanted to initially expand in an area and that location, that was the only location available at the time. And now there's a new development for them to move to, even if the rent's higher, where they think they're going to achieve higher sales per square foot.
So that would be a nice little windfall to all of a sudden have a building as part of your asset base there. Nice little surprise.
Yeah, that's why you really have to make sure, when you're analyzing the market rents with the particular box size, the size of the building, you have to really make sure that you have a strong tenant. If you're paying close to market rents with a rental increase, you don't want to be taking a risk on a small franchisee or a mom and pop type tenant, because if you can't get those same rents upon the release, your equity you put down to buy the property could evaporate with the lower rents.
And then we've seen a lot of clients over the years where they'll sell the property to a sale leaseback type transaction, or you even get folks that have a very high level of debt on their current property, so they need high levels of debt on the new property. And what type of solutions are out there for those type of investors?
There's a couple of different options. It just really depends on their individual goals. So with a sale leaseback, often what's in the flyer is what the tenant is proposing that they would desire for a sale leaseback to occur. That's not set in stone. You can always request, if they don't want to do a personal guarantee, you could request a personal guarantee. If they only want a single entity corporation out of their 30 units to back the lease, but you want all 30 locations backing the lease, if there's 5%, 10% rental increase every 5 years, you could request it to be 2% rental increase every year. Everything is open to negotiation in a sale leaseback. And if you have a higher amount to exchange, sometimes you can do a zero cash flow deal, which basically what that means is there will be like a a Walgreens with a loan in place. And so the payment that you make every month that's coming off the rent goes to accelerate the pay down of the mortgage. So when the loan ends, you'll have a on the property, you'll have a pay off property free and clear. But the cool part about that is they have a re-advance feature. So for instance, if buying a normal Walgreens required, let's say 30% down, some of these can be bought with 20% down with a special loan in place. And then after you close, you can re-advance the unused excess funds to buy another property with and still be 1031 exchange compliant. So if you had 3 million or 4 million to exchange and you're buying a larger property, but it only takes say 3 million to assume the loan, then you send a letter to your lender to re-advance the funds back to you after closing. And you could take that extra million and take your time on looking for other properties to buy.
And the zero cash flow, that probably creates some kind of phantom income that the investor needs to be aware of.
There's specific commercial retail attorneys that specifically focus on the zero cash flow transactions. And so it's real critical if you're looking at doing that type of purchase that you look at phantom gains and you look at the process there's specific processes that have to be really followed and to be compliant. And you really have to be using, a commercial retail attorney that's familiar with the zero cash flow deals.
And with all the different net lease structures we've talked about, could we maybe focus on some of the tenants you see out there? What are the more common tenants that would be involved with a net lease property? And maybe give the listeners some idea of what they can expect out there.
So really with COVID, it's kind of changed the landscape for triple net properties. So typically before COVID, you could have a 20 or 25 unit franchisee, for an example of a Taco Bell. And you would go and look at the cap rate versus the parent corporation of Taco Bell guaranteeing the lease. You could get a little bit higher cap rate. And then when you went to a lender for a loan quote, you could get the interest rate was maybe a little bit higher. It was maybe a 25-year AM instead of a 30-year AM. And you could still make those properties work and maybe come out 20 or 30 basis points better on the cap rate. And you could do good on those properties and it was still an acceptable risk. Now, mid-COVID, a lot of the lenders don't know if some of those tenants are going to survive or how those franchisees at some of the locations are going to shut down. And so a lot of the lenders now, they want set 35% down for those type of tenants. They want 40, 45% down. They want 20-year AM and they want higher interest rates. So now those properties really don't work. So what you have in the market is you have properties that are, dark spaces or bought at auction, super high value add, stable, do them to stabilization and create the value. Or you have what we call the jewelry box properties, the diamond properties, the investment grade tenants, such as DaVita Dallases, Fresnises, Walgreens, CVS, Starbucks, some of the AutoZones, the O'Reillys. Those are the type of tenants that lenders going forward want to really shore up their balance sheets with solid loans and solid borrowers. And so they don't really want to loan out on mom and pop, triple net tenants, or small franchisees where the chance of default is high in the future.
And do you see more and more of these going kind of a corporate guarantee? Has that changed at all because of COVID-19? Or is the mix between mom and pop and corporate guarantee type leases still about the same as it was?
There's a lot of there's kind of a lot of junk on the market. So there's a lot of what I would call mom and pop leases or small franchisee where they don't disclose their sales or their financials, and those are highly risky properties. The way that I evaluate those types of properties for my clients is, let's do a case study. Let's say we have a Bojangles with a 10-unit franchisee. For the Bojangles, let's say it's 2,500 square foot in size. If the rent that's in place is, say, $15 a foot and the market rent is $25 a foot, then if I buy that property and the tenant goes dark, even with my releasing cost and leasing commissions and tenant improvements and attorney's fees to negotiate, I can still put it back out there at 20 or 21 bucks a foot, and I can still increase value in the property and make money. If it's a small franchisee where market rent's 25 a foot and they're paying 24 a foot, then with all my release costs, if they go dark and lost rent, I can stand to lose money and some of my equity down payment in that situation. So anytime it's a mom and pop tenant or a weaker franchisee tenant, they're paying close to market rents, that's just, it's a bad deal a lot of times.
And one of the things that net lease properties seem to be very much tied to is the interest rates you can borrow at. What type of risk does the investor look at in terms of buying into a net lease investment and then the financing costs, et cetera?
So typically on commercial real estate loans, specifically triple net loans, there's typically, a 5-year fixed, a 7-year fixed, and a 10-year fixed loan. I typically advise my clients to do a 7 to 10-year fixed because most economic cycles, from a downturn to a peak, run about 10 years on average. So I typically want them to have 7 or 10 years fixed, so they have time to pay down the mortgage and then have time to refinance or sell and 1031 exchange into something else at the right time, versus maybe you're getting 10 basis points less on the interest rate, but you're losing security of having that fixed rate loan for 7 or 10 years instead of the 5, and it might not be the opportune time to refinance or sell at that time. And these triple net leases have fixed rent. So when they have fixed rent with a fixed lease and fixed increases, it's better to have a long-term fixed rate loan in that situation. You don't want to have to refi at a much higher rate, but now you've got a fixed lease where you are getting diminishing returns, or the interest rate is higher and you haven't paid down enough. The lender might come back and to do a refinance, they might require you to pay down than you did before to meet debt service coverage ratio requirements.
And especially with COVID-19 today, it sounds like a 7 or 10 year would give you plenty of time to kind of work out whatever may happen down the road. I think there's probably still going to be quite a bit of fallout with retail and maybe even some commercial office that we haven't seen yet. So that'll give them time to kind of work out the bugs as things happen.
Yeah, with office, I really like medical office. It's almost, triple net now. A lot of times the medical tenants used to be in, 8 to 10 story office buildings, but now they're going more neighborhood street retail. They want to be in a small retail strip center on the main road where they can see their sign easily and they can pull in and go in and out of the properties easily. A lot of their clients might be elderly and up in age, and they have a hard time going into a large building and walking long distances to get into these medical facilities. So I like medical office. There's usually high tenant improvements, and it's hard for those doctors to move somewhere else and create their customer base again, because they often can't move with them. They're in a specific area and geography. Regular office, I don't care for. It's easy for people to, demand less space or move to a warehouse for cheaper rent per square foot, or move into the basement of their house or something, or some kind of, office at their house, and they can meet 1 or 2 days and be gone the next day.
And I think one of the fears out there today is, of course, retail. That's probably got hit the hardest with COVID-19 and everything that's going on. So based on your comment, it sounds like maybe one of the ways they can repurpose the retail space is just that, is kind of convert to different types of medical office type space. Is that kind of a trend that you're seeing?
Yeah, so there's a lot of, medical, they're definitely moving to the neighborhood street retail. I'm definitely seeing a trend with that. With the retail, it's really the large big box retail has kind of been right sizing over the last decade. So, you see something like Kohl's used to be a 120,000 square foot store. Now they're a 65,000 square foot store. And they have a certain section of the front of the store where you can come in and pick up stuff you've ordered online. So they're right sizing the brick and mortar spaces. The neighborhood street retail that's 20,000 square feet and below, there's huge demand for that retail. Now certain cold belt states versus warm belt states have a problem. So in the United States, we have retail per square foot. We have some of the most per square foot retail in the world. So certain areas of the country are over retailed. And especially in coal belt states, there's a lot of people that are moving away with net migration to the, so about 75% and net migration is moving away to Georgia, Florida, Texas, and the remaining 25% is moving to Nevada, Arizona, some of the tweener states that are, when someone wants to move down to a warm belt state, but not all the way down, they come to South Carolina, North Carolina, Tennessee. And so what you'll find is in the coal belt states, there's small isolated pockets of strong suburban to urban core, high income areas that are still growing. But in between that, there's a lot of areas, the population levels are declining. Tenants don't want to expand in those areas for growth. They want to be in the warm belt states. And so that's really where most of my clients are buying is in the warm belt states now.
Then you probably have the wonderful California effect where everybody's trying to get the heck out.
Yeah. What's interesting? California, I have a bunch of clients in California, and there's basically kind of two premises. So one is a lot of my clients are selling off everything they have in California as a residence house, and that way if it gets so bad, they can just sell up their house and move out of state. And so they're buying properties in other states that they might possibly want to move to. And then that way, if it gets so bad, they can sell their primary house, and then they already own commercial real estate in the area they want to move to. And then I've got another set in California where they're like, we know the taxes are high, we don't agree with the political landscape, but we love the area. They might not live in LA or San Francisco. They might be in, one of the smaller counties, more, in the valleys and things like that. They grew up there and they don't want to move. So they'll still, buy and invest in other states, but they're just going to live there forever. And then I typically tell people, here's another thing too that we haven't talked about. So, I often get asked by people, should they do a 1031 exchange if they're in California, or do a HELOC or a refinance? And my answer is, California is more an appreciation market. Do you want to own this property for another 8 or 10 years? Because we're kind of at peak values in California. There's probably likely going to be a downturn, and you can 1031 exchange 100% of your proceeds out into another property and get a much higher return and not have that trapped equity. Some of them only are getting 1% return on equity in the property because it shot up in value, but they're not getting any kind of return. Or you can refinance and take up to maybe 75% of that value, and then buy something in another. But then it all comes down to your personal choice. Do you want to wait for the next run up and own that piece of real estate for the next 10 years?
California is certainly an interesting market where you have those peaks and valleys that a lot of those states don't have. So it is a way to get out at the top and lock it in someplace else where you won't have those huge swings. And I think one of the things I want to throw in there real quick is investors that are selling in California and exchanging out of state. California has this wonderful thing that we've nicknamed the California clawback. California always takes the position if you sell California and you reinvest out of state, it is tax deferred because you've done a 1031 exchange, but they want quote unquote their fair share if you ever sell and cash out and pay the tax. So just you have to be aware of if you're exchanging out of state, you do have to file an information return with California each year just to report the status of that. And a lot of the tax experts we talk to think that's unconstitutional. So when clients ask, well, should we do it or should we not? It's like, I think you do what's right for you from an investment perspective, and you can keep holding or keep exchanging. You'll never have to pay California. And I think at some point, somebody will finally step up to the plate and go after California and will win. And then at that point, it becomes tax-free from a state perspective, at least from California's perspective. So I wouldn't let that, hold the investors back per se. Go ahead.
I was going to mention one of my clients in California mentioned, I don't know the proposition number, but they said some kind of proposition passed under false pretenses, and it was something to affect maybe the stepped up basis of the value of the property that they're trying to pass all these different propositions in California. Have you heard anything about that? Or?
I have. In fact, that's funny. Our next episode is on that topic specifically. So it's Proposition 19, and it impacts the investor in a number of different ways. So one is you lose the step up in cost basis on investment properties and what have you. So you're going to see a lot of people exchanging out of California because they're going to realize, it doesn't really affect me today, but when I pass on and I leave it to my kids or my grandkids or whomever, they're going to get a huge increase in property tax, and they may not be able to afford to keep it. And at that point, they'd have to sell just to deal with it. Where if you sell California 1031 exchange into out-of-state property, then you will avoid Proposition 19. There's also your primary residence. They can roll over a certain amount of the property tax cost basis, but the person who inherits the property has to actually move in and live there as their primary residence. Well, a lot of people don't want to live in their parents' house. So it's going to create a lot of issues there. And you're absolutely right. The term false pretense was exactly right. The advertising campaigns and the mailers that were put out made it sound like it was this great thing and it had all sorts of public benefit, and it was extremely misleading. I would actually say it was sales fraud. And so voters voted for it thinking this is a great thing and not realizing it was actually a horrible thing. And unfortunately, now we're stuck with it. So our next episode will be specifically on that. We have someone from the San Diego County Assessor Recorder's Office that's going to talk about Prop 19.
I would think if that passed under false pretenses, I think there would kind of be maybe mass litigation in court against them for trying to pass something like that in the future. Wouldn't you think?
You would hope, and there's been attempts to change the way propositions can be introduced, and that never seems to succeed. The court cases often fail because the proposition is very specific. It's worded the way they've worded it, and the courts will take the position, well, you didn't read it, so you didn't know what you're voting for, and it's the advertising. But you would think there'd be a way to prevent that. It's kind of funny. It's kind of going back to the definition of insanity. You keep doing something over and over and over, and you hope for a different outcome, but it never happens. And so we keep voting for the same people. The Democratic Party has controlled the state for almost 3 decades, and we keep voting them in, and we keep hoping for a different outcome, and it never happens. So at what point do people start voting for people who can solve the problem? That is a good question.
Yeah, that would be yeah. If it makes sense, don't do it. That's their premise.
Absolutely. So going back to net lease real quick, we had kind of touched upon kind of the corporate guarantee and what have you. So maybe we could delve a little deeper into that, because obviously I think that's one of the biggest ways you can minimize your risk is get the right types of guarantees out there. So could you maybe go into a little detail there and what investors should look for, and what are your thoughts on that?
So just real quick on the types of leases, the one thing we didn't talk about was a leasehold. A leasehold, you're not going to run into it that often, and they're very hard to finance. They're often at higher cap rates, but it's where a developer wants to develop a piece of property, but the landowner doesn't want to sell. And so basically what happens is there's a ground lease that's created, and then the developer just owns the building, and they sell off the income with the building. So in a leasehold, you're owning the building, but not the land in that situation. So you can depreciate 100% of the building. So that's a benefit. But one of the downsides is you still have a ground lease payment that you're having to make in that situation. So they're risky, and they're very hard to finance. Often the lenders want the ground lease owner to subordinate the foreclosure rights to the lender that's given the loan on the building, and that creates a problem because often the ground lease owner doesn't want to do that. But I just wanted to get that in there because I know we didn't touch on that, but it's very rare and not a lot of people buy the leaseholds.
That's a good point. I would think that if you're the leasehold owner or investor, it'd be a lot more difficult for you to resell that interest because you're still subject to the ground lease. So it's probably got some liquidity issues as well.
Yeah, it's tough. In certain situations, they work. You get them at a higher cap rate, and you're hoping the tenant stays long enough to get back the value that you put in and then make a higher return. But they're super risky with a lot of things that can go wrong. So, not many people buy them. It could work in certain situations where the location is just it's an A+ location. And sometimes what I do with clients, if they really want to go for that, is we want to look at the ground lease. And, if the developer was smart, they have a right of first refusal to where if the ground lease owner ever wants to sell the property, they get the first rights on it to buy it. So then that way they own that, premium A location land and the building. They have the option of being able to buy that instead of the ground lease being able to be sold to someone else and you just still own the building.
And how do they protect how does the investor protect themselves with the various guarantee options that might be out there?
So typically I call it my 5 levels, and I use an example of, everybody pretty much knows Yum Brands, they have a KFC and Pizza Hut, Taco Bell. So on the strength of the guarantee, a triple B minus investment grade by standard is typically one of the strongest credits you can get. They analyze those businesses on a weekly, monthly basis. And then typically the stronger the credit rating, the less of a chance of default. So, the default rate might be 0.5% or 1% for a triple B minus investment grade or better tenant, or at most maybe 2%. Whereas if you're below the triple B minus where you're credit rated, but you're not investment grade, it can be a 10% default rate or 11% default rate. And the lenders don't want to lend to those types of properties because they think there's a high chance of default in the future. And so, typically parent corporation investment grade guarantee is typically the strongest you can get with a lease. And then below that would be a subsidiary. So let's say subsidiary of Yum Brands or the parent corporation, and it's guaranteeing instead of 12,000 locations, it's guaranteed states and 4,000 locations. And then below that would be a large franchisee in the system that owns a couple hundred units that's been in the system for maybe 15 or 20 years. And then below that would be a small franchisee that maybe owns a single location up to maybe 5, 10, 15 locations. And then below that would be a mom and pop tenant. It's not even a Taco Bell. They don't even have a marketing or advertising campaign. It's just a local mom and pop shop, down the street, and they're given a personal guarantee in the lease.
Perfect. We're going to take a quick break for a message from our sponsor. This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750 or visit them on the internet at exetertrustcompany.net. We've gotten some great information so far on the net lease properties, and today we're with Joel Owen with triplenetinvest.com. And Joel, let's go into kind of the location. That's what it's all about, I think. And so that'll kind of give the listeners some ideas on how important that is to net lease properties.
Yeah, so I kind of coined the phrase over the years, dirt first. So I used to work assembling commercial land parcels for developers, and then I sold large apartment buildings. And then over the past decade, I've just done all retail triple net. And so the value of the location long-term is huge to the success of an investor. So there's usually, urban core, strong suburban, weak suburban, and rural areas. I don't like weak suburban or rural locations unless the investor lives there and intimately knows that market. I like urban core and strong suburban. The weak suburban to rural locations are typically last to recover in an economic cycle, and they're the first to fall. And typically what I find is even if national tenants go into a weak suburban to rural market, they'll actually have termination clauses in the lease early, where if they don't meet certain sales figures, they can cancel the lease and move. And they usually retract back in a down cycle to the strong suburban and urban core locations. And then you can't get the same rents per foot that they were paying with a mom and pop tenant. on the release, and then you lose your equity down payment. Whereas the strong suburban to urban core areas, typically over time, the cities and the counties, as the population grows, they relax the zoning laws. So I've seen before where a, 80-unit apartment building that was built in the 80s that was sitting on 14 acres, now they allow 500 units on that 14 acres, decades later, because once so much growth happens with population, there's nowhere for the people to go. There's only so much land to build on, and so eventually you have to build on top of the existing structures or scrape old buildings and build new. And so typically the air rights to the property become more valuable, and the dirt becomes more valuable over time, as there's only so much land in the area.
And if an investor was to work with you, probably one of the questions they'd ask is, I want to invest in whatever you would invest in. So what would your watch list be for various net lease property investments?
When I work with clients, the main difference between, the way to answer this question is a lot of people don't know how the commercial real estate space works. And so typically the commercial real estate brokerages focus on listings and the listing side. And they typically have, usually 3 people to a team, and they do volume. So basically, because of their commission fee split structure, out of 100,000 commission, 50,000 typically goes to the parent company, and the remaining 3 agents on the team, the senior director might be getting, 27,000 out of the remaining 50,000, and then the junior agent might be getting 6,000 or 7,000 out of the remaining 50,000. So out of a total 100,000 commission, they typically have to do 6 to 10 transactions to my 1 transaction. So what that makes happen is typically when the buyers are working with these listing companies, they typically only want to sell you what's in their inventory, whether it's a good, bad, marginal deal. And you're typically buying, assets that they're just kind of the leftovers, because they want to do that mass volume of sales and transactions. Whereas on my side, I'm looking as if, I'm the investor for the client. Like, it's something I would like to buy. I typically only like maybe 15% of the properties I see on the market. I'm looking for urban core to strong suburban locations. I'm looking for investment grade quality tenant. I'm making sure the rents aren't way above market. There's a long-term lease in place. There's no early termination clauses or outs for the tenants. I'm looking for those kind of things for my client. And, if it takes so many months to find that, it's fine. Because with me owning my own company, I keep all the money. So I'm not running on a hamster wheel trying to do volume like these other brokerages that focus on the listings instead of the buyers.
That's the key, really, is do what's right for the client and get the right investment option. And that's the name of the game. We had talked a little bit about interest rates and kind of the risk, and most of what we talked about is the positives and what to look for. So maybe address the loans that are placed on these type of assets and the type of credit risk or interest rate risk that might be involved with this.
So often people will be drawn into a higher cap rate by a mom and pop tenant or a franchisee for the remaining terms, remaining years left on the primary lease term, but they don't understand in the triple net space how financing works. And so they see that higher cap rate, but then they go get a quote from a lender and they find out they're not going to get the kind of cash flow or returns that they're looking for. So as an example, anything typically 8 years remaining on the primary lease term or less, it's very hard to finance in the triple net space because the lenders will do an appraised current value with a tenant in place in the income, and then they'll do a dark value of the property with no income, just the land and the building value. And they want the mortgage balance, if the tenant doesn't renew the option, they want the mortgage balance to be at or less than what the dark value of the building will be. That way, if the landlord can't renew the lease and the lender had to foreclose, then they can be made whole on the loan, and they're not taking a big loss on the property. So often when they go through this exercise, they'll find that they have to put 50% down. The amortization, instead of a 30-year AM, it's a 20-year AM. And so all the expected cash flow they thought they were getting from the higher cap rate is actually going to accelerate the mortgage paid out every month. So they're not getting the cash flow that they thought they would get from the property. Or if it's a mom and pop tenant, they're giving a much higher interest rate because of the risk profile. Typically, when you're looking at these properties, if you have an investment grade credit tenant, they might put 80% weight on that tenant, say a DaVita Dallas, and only 20% on the borrower. When you go down to a regional operator, it's maybe 50% on the borrower, 50% on the tenant. And when it's a small franchisee to mom and pop tenant, they're heavily going to look at the borrower's income and guaranteeing the loan, and only maybe 20% on the tenant itself. Whereas, as an example, I just closed with a client in December of last year on an Aspen Dental. It was about a 6.25 cap rate. The buyer put approximately 32% down, and we've got a 7-year fixed rate loan with a 30-year AM at it was like a 3.85% interest rate. So anytime on a triple net property, you have a 200 basis point spread between the interest rate on the loan and the cap rate on the property, you're typically doing pretty well in that space.
And if, today, obviously, we have COVID-19, and the response to that has been phenomenally low interest rates. So if an investor buys in today with these low rates, and then rates start to creep back up over the next, say, 4 or 5 years or something like that, what's the exposure to the investor? How do they mitigate that? I guess part of that question, too, would be what's the optimal holding period for a triple net lease or net lease property with all of that?
Recently, over the past couple of years, FASB, the Financial Accounting Standards Board, has changed the way that tenants have to book their lease obligations. And so used to, the tenants would want to go for, long as possible, 20, 25-year primary lease term with option. But now the way FASB makes them report that obligation, a lot of them now in the space, the longest you'll see is maybe a 20-year lease term, but most of the time now it's a 10 to 15-year primary lease term. And so I tell my clients, optimally, if you're going to think about selling after holding so many years, do it before 8 years the remaining primary lease term burns off of the lease, because once it goes below that 8-year mark, it's very hard for buyers to get good financing on those properties. And so it can make it tough when you go to sell your property. The cap rate might have to rise a lot in that situation. Often my clients think about holding for 10 years, but 3 years later, they get an unsolicited offer from a buyer that's got a 1031 exchange or something else. They're just wanting to buy the property, and they give them an offer they can't refuse. And then they 1031 exchange into, another property. The other part of it too is it depends on the price point. So in the triple net space, 3 million price point and below, a large majority of the purchasers are cash purchasers. 4, 5, and 6 million above, even if someone has all cash, they typically don't place it at one property. They don't want that high concentration of cash in one property. They're going to put a loan on it. So what that means is when interest rates rise in the market, the 3 million and below, where people are mainly paying cash, the cap rates aren't going to be as affected as if the interest rates rise and then people are selling the $5, $6, $7 million type triple net properties where a majority of the buyers are going to use debt that are purchasing their property. That's going to affect things more when interest rates rise.
Gotcha. And we've heard a lot of people say, hold a net lease for about 50% when you're halfway through the term, then get out. But it sounds like the terms have changed to where maybe 10 or 15 years. So now it's really don't go below 8 years is really the guiding factor, and kind of ignore the 50%.
Yeah, because they changed the, there used to be 20, 25-year primary term leases. And then what happened is the tenants, because of FASB, they would desire, if they could get away with it, they would desire a 5-year fix. But see, as a developer, if I develop a piece of property and I know that it's got to have at least 8 years or longer on it for a buyer to get good financing on it, well, as a developer, I'm not going to agree to a 5-year primary term with a tenant. There's not enough security there for a lender to give a good loan with rate and terms on something like that, to have pay down It just, the underwriting doesn't work. And so 10 years for new development is kind of the cutoff point where the developers push back and say, we're not going below 10 years on a new primary term single tenant net lease. We're not gonna do that. So, now it's created where, kind of 15 years is a brand new lease term. You're going to pay the lowest cap rate for that because the developer hasn't made any money on that property yet. They haven't made any cash flow. They have short-term capital gains if they, don't do an exchange, and they have, real estate commissions and attorney legal fees. So, typically if the years go down to say 11 or 12 years remaining on the primary term of the lease, you can typically get a slightly higher cap rate, maybe 20 or 30 basis points higher, but you can still almost get the same identical loan terms you would have gotten with a 15-year primary term lease. So that's a way to extract a little bit more value there.
Super. And for investors who would love to work with you, how do they get in contact with you, and what's the best way they can work with you?
So I only work with clients on an exclusive basis. They work with me one-on-one, and I work with them. Typically, the best way to do it is to go to my website, which is NNNinvest.com. And then there's a button on the main page that you'll see that says Start Today. You click that, and there's a form to fill out. And once you fill out the form and hit Submit, then I will review that form, and then I will be in touch with them to set up a call. It's important that we have a call because I need to see, is most of their money in an IRA account? They're thinking of using a self-directed IRA to buy a property, because if there's special loan requirements with that, non-recourse provisions. The interest rate tends to be higher. The lenders are looking for certain liquidity and net worth. So if the borrower makes good income, but all their net worth is tied up in the properties, they might be, too heavily tied up into hard assets and not have enough liquid to meet the requirements for that lender to buy a property. So there's some pre-planning that has to go in motion, especially with a 1031 exchange, where they have to reach out early on and not wait in the process.
And I can say we've worked with you for quite a while with a number of investors, and you are by far different than your competition. Most of them, like you said, are just salespeople, and they just process, and they've got volume, and they never really consult with the client on what they need and what their objectives and what their goals are and whatnot. So that sets you above and beyond the competition.
What I offer is more of a premium service, all inclusive, the capital markets mortgage brokers. I have a, on and off market database I built up over 17 years of property owners. I have retail property management companies if they're needed, 1031 exchange companies, and then the commercial retail attorneys. So I'm more for the person that wants that premium service and that one-on-one attention. Often, doctors or people that sold a business or people that inherited a lot of money with an estate, they might be successful in their area of expertise, but they don't know about the triple net space, and they really need someone to guide them and be there for them through the whole process, instead of the typical brokerage that just hands off and ask in 3 or 4 weeks if it blew up or it didn't close because they're doing so much volume. So I'm not for everyone, but for the ones that need a premium one-on-one service to help them with their goals, I'm a good fit for that.
Terrific. And thank you so much for all that information. That was great information for our listeners. And we've been speaking with Joel Owen with Triple Net Invest, and you can reach him at triplenetinvest.com. Joel, thank you so much for spending time with us today.
Thanks, Bill. It was a pleasure.
That was some great information from Joel Owens with triplenetinvest.com on how you can use net lease properties as a potential replacement property in your 1031 exchange transaction. So thank you for joining us today and listening to Go Ahead Ask podcast. Our next episode is what we had just kind of talked about with Joel a minute ago, which is unraveling the mystery of the California Proposition 19. Voters were very much misled by the Democratic Party in their advertising and mailing campaigns and didn't realize what they were truly voting on. We're going to interview Jordan Marks, who's an attorney and a taxpayer advocate with the San Diego County Assessor Recorder's Office, to get the nitty-gritty on Proposition 19 and how it will affect you when you leave property to your kids and grandkids or other people who may inherit your assets. So don't forget, if you have questions, you have a topic you'd like us to cover, email us at ask@exetercode.com, or you can call us at area code 619-239-3091. Again, that is 619-239-3091. And if you like our podcast or even love our podcast, like it, subscribe to it, and share it. We'd very much appreciate that. You can find us on just about every social media application out there. Thank you again for watching today's podcast, and we'll see you next time.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.